Looking to understand how taxes work as a trader or an investor? Well, don't worry, I got you. Because in this episode, I'm going to be breaking down how taxes work, whether you're in a trading account or a traditional retirement account. Let's get into it. Hey, welcome to the Money Markets and Mindset Podcast. I'm your host, stock market coach and option trader, Jason Brown. And I want to talk about taxes because it's that season. Depending on when you're watching this, we're in the middle or getting ready to go into tax season. And most people don't understand how taxes work as a trader or an investor, especially when people ask questions like, how can I avoid taxes as a trader? And that lets me know that they either have never made any real money in the stock market or they just simply don't understand how taxes work, because when it comes to the stock market, there's not that many ways that you can avoid taxes, but there are things that you should be aware of to potentially pay a little bit less, or some things that you can do to minimize your tax liability altogether. But it starts with the type of account you're trading in and all of that. So let's kick it off with talking about first the three type of accounts that most people have that they're investing in. And so the number one account that most people are quote unquote trading in, day trading, swing trading, option trading in, it's just a regular brokerage account, whether that's with WEBULL, Robinhood, TD Ameritrade, E-Trade, Charles Schwab, TradeStation, you name it. If you're just taking money, putting it in the account, buying some stock, hoping it goes up, or buying some options, hoping it goes up or down, and taking a quick profit, you're in a regular brokerage account. So it has nothing to do with retirement, which brings us to our second account, which is a qualified retirement account. If you're investing in a qualified retirement account, that may be a 401k if you work for some type of a company or a corporate job. If you work in the public sector, you're a policeman, a firefighter, a teacher, something like that, you might know it as a 403b. They're essentially the same, but one is for corporate companies and one is for more public servant industry type jobs. So both of those are going to be qualified accounts. And then the last one is a traditional IRA or a Roth IRA or a rollover IRA. An IRA just stands for an individual retirement account. And we'll talk about that in a second. So let's first break down a regular brokerage account. So when you're investing or trading out of a regular brokerage account, there's two types of time frames that's going to be important that is not important when you think about the qualified retirement account and the traditional IRA. And so these time frames are going to be called short term and long term. Or more specifically, the question that you're going to be asking yourself is, am I paying short term capital gains in my regular brokerage account, or am I paying long term capital gains in my regular brokerage account? Now, short term is super simple. It's any security or stock option that basically you hold for 12 months or less. So you hold it for less than a year. The IRS is going to consider that a short-term capital gain, assuming that you made some money on that investment or that trade. Now, a long-term capital gain is going to be anything that you hold for 1 year or longer. So if you hold that stock, that option, that security for a period of 1 year over, then you're going to qualify under long-term capital gains. Now, why is this important? Because these are the two ways that you're taxed as a trader, as an investor, if it's outside of a retirement account. Again, we'll get to the retirement accounts in a second, but these are the two ways that you're taxed. And so basically you're taxed as ordinary income. Now, what does ordinary income mean, Jason Brown? Ordinary income means the money that you make is going to be tacked on to your ordinary income that you would make from a job. So let's just say, for the sake of this example, if you make $50,000 on your job, well, you're going to pay taxes on $50,000 from your job. They probably already take it out every other paycheck. Now, let's say you also make $10,000 from your brokerage account, whether it's day trading, short-term, swing trading, long-term trading, doesn't matter. It's not in a qualified retirement plan. You made an additional $10,000 from the stock market. They're going to tack that $10,000 on to your regular $50,000 that you made from your job. And now they're going to tax that extra $10,000 as ordinary income. So just think of it as it's as if you made $60,000 from your job that year. That's a very simple way to think about it. But here's the little twist. That extra 10,000, they're going to tax that under two different tax rates. So again, if it's under 12 months, they're going to tax you under the short-term capital gains tax bracket. So let me run through some of those numbers and give you an idea of what that looks like. These charts can get very long and convoluted because the tax falls under, number one, if it's short term, there's a tax bracket for that. But then there's a tax bracket for if it's short term and you're filing single, if you're short term and you're married, filing jointly, if you're short term and you're married, filing separately, if you are short term and filing single but head of household, don't quote me on that. So you get what I'm saying? Those are the different scenarios in which the bracket can change. So you want to find the bracket that fits how you file your taxes. If you don't know how you file your taxes, just check with your tax consultant that you pay every year to do your taxes. They'll know if you're filing jointly, singly, head of household, all of that stuff. But let me just give you an example if you are a single filer. So if you make, let's just say $10,000 from the stock. Well, let me back up. Let me back up for a second. It's based off taxable income bracket. So if we stick with the initial bracket of making $50,000, you would fall in the bracket of making anywhere between, this bracket is $40,000 to 86 roughly $1,000. That bracket would put you in the 22% bracket. It goes like this. If you make $0 to about $10,000, you're going to be in a 10% tax bracket. If you make $10,000 to about $40,000, I'm giving you round numbers, you're going to be in a 12% tax bracket. And again, an example we use, if you make $50,000 on your job, you're going to be in the $40,000 to $86,000 rough bracket, which is 22%, which means if you make $50,000 from your job and you make an additional $10,000 from the stock market, that's $60,000. So you fall in that bracket. The stock market portion will be taxed at 22%. So that $10,000 that you made, you will owe $2,200 to the government, and you get to keep the rest for yourself. So it's real important to know that, so that you don't just take all the money, go out, spend it, blow it, party, and then find out that you actually owe some money to good old Uncle Sam. Now, let's just say you made $50,000 on your job, but you made an additional $50,000 from the stock market. Well, what happens is when you only made $50,000 from your job, you were in the 22% bracket. But when you made an additional $50,000, that puts you at a taxable ordinary income, and it's for short-term capital gains, of $100,000. $50,000 from your job, $50,000 profit from the stock market. It now looks as if you made $100,000 in ordinary income. So that jumps you to the next bracket. Well, what's the next bracket? $86,000 to $165,000 roughly. That's a 24% tax bracket. And so now that extra $50,000 is taxed at 24%. So over $10,000 is what you'll owe in taxes, assuming that you make $50,000 on your job and you made $50,000 from the stock market. Now this bracket continues on and goes as high as 37%. Once you make over $525,000 roughly, it maxes out at about 37%. So you will pay 37% capital gains tax, short-term capital gains tax on the amount that you make from the stock market that puts your total income above $525,000. So that is the max that you would pay under short-term capital gains. Now, let's take a look at long-term capital gains and how this changes just a little bit. So instead of walking you through each category, I'll just jump to the top tax bracket under long-term capital gains. So under long-term capital gains, it doesn't really matter how much you make. You will be taxed at 20%, the max at long-term capital gains. And so it may be important at this moment for me to share that the tax code is progressive. I believe I'm saying that right, which means the money that you make from 0 to 40,000 is taxed at a certain percent. Then the money that you make from 40,000 to whatever that bracket is taxed at that percent. And then the money you make above that is taxed at a different percent. So not all the money is taxed at one time at the same amount. Typically, the money is taxed in tiers as you move up through the different brackets, or at least your ordinary income is taxed in tiers. And then your stock market capital gains, I believe, don't hold me to this, I'm not a tax professional, is taxed in tiers as well. But even if it's not taxed in tiers, you just find where you're at on this bracket. So if you're long-term capital gains, meaning you held it for longer than a year, if you're single and you made 0 to about $40,000 a year, you will pay no money in capital gains tax. So how does that work, Jason Brown? You're saying if I'm in the bracket from 0 to 40,000, I can pay no money in capital gains tax. So yes, let's just say you make $30,000 on your job and you made $10,000 from the stock market. Well, that would put your total ordinary income at 40,000. Well, this bracket from 0 to $40,400, you pay 0% in tax if it's a long-term capital gain, meaning you held the security for over a year. You can pull that $10,000 out as long as you made total combined less than 40,000. You can pull that $10,000 out and you pay no money in taxes, which is pretty sweet. If you're married filing jointly and you have a long-term capital gain, as long as you're in the bracket from 0 to 80,000, you pay no capital gains tax. So for example, if you make 35,000, let's say you make 30,000 and your spouse makes 30,000. You both make a combined 60,000. That means you can make an additional $20,000 from the stock market, which will put you at 80,000, and that's a 0% tax threshold for married filing jointly on long-term capital gains, meaning that you held your stock option security for more than a year. And so you can start to see, depending on how much money you have and how you're investing, sometimes it's a benefit to invest for the long term, because depending on what tax bracket that you're in, you can actually walk away not paying much or anything at all, depending on how much you made from the stock market. And when you mix that with your ordinary income, what bracket that puts you in. So I hope that makes sense. Now, a lot of people say, well, how do I avoid taxes altogether from the stock market? It's basically virtually mission impossible. There are no tax deductions for being an investor in the stock market. There are no tax breaks. I will share with you some tax benefits of doing this in a 401k, 403b, traditional Roth IRA. But if you're just trading in a regular account, there are no tax breaks. There is no way to shelter the tax. There is no, let me take the stock market money and go buy a house or a property. It does not work like that. If you made money, it's going to get taxed as ordinary income, and it's either going to fall under short term or long term. And so they're going to add that ordinary income to what you make on your job. And then they're going to say, was it long term over 12 months or was it short term under 12 months? And there's a grid, and pop, that is what it's going to get taxed at. There is no way to escape the taxes from making money trading in a regular stock market account. Now, there is a status that you can file for called trader tax status. That's something for another video. So maybe check the link in the descriptions. We'll shoot another video about that if more people want to know about it. But that's a tax status that if your money primarily comes from stocks and options trading, you can get a special tax status as a trader. But it's more so that you can write off losses more so than it is that you can avoid or lower your tax burden. Now, one last thing to touch on as an individual trader before we go into the qualified accounts, retirement accounts, traditional IRAs, is that what happens if you lose money? So we talked about what happens if you make money. You're just going to ask two questions. Was it long-term or short-term? Okay. And then the second thing they're going to do is tack that profit on to your ordinary income, money that you made from your job. And then you're going to come somewhere in one of these tax brackets under long-term or short-term, and boom, that is the percentage that you are going to pay. But what happens if you lose money in the stock market? So if you lose money, it doesn't matter what your tax bracket or any of that stuff really is. Most people don't know that you can only write off $3,000 of a loss per year. So to give you an example, let's just say you lost let's say you lost $30,000. $30,000. You lost $30,000 in the stock market. Well, come tax time, you can only write off $3,000. You can claim $3,000 as a loss. So what happens to the other $27,000? You can basically do what's called a carry forward. So next year, if you have a loss again in the stock market, you can write off another $3,000. So then you would have $24,000 carry forward until the following year. Now, here's what's nice about that. And I always tell members, if you don't quit, you can at some point get the money back, because let's say in year one, you lost $30,000. So you wrote that off, you wrote $3,000 off. So you go into year two and you say, well, I'm not going to trade at all in year two. I'm just going to study. I'm going to figure this thing out, see if I really know what I know. And in year two, you don't do any investing. So you didn't make or lose any money, but you still had that $27,000 carry forward loss. You get to write off $3,000 again. So you go into year three with $24,000 loss. Now, let's say in year three, you make $30,000. Well, you won't have to pay taxes on the entire $30,000 because you're carrying forward a $24,000 loss for the last 3 years. And so now you're going to say you made $30,000 this year, but you're carrying forward a loss of $24,000. So you'll only have to pay taxes on the $6,000 difference, which is pretty cool as long as you stay in the game and can get yourself back to a point where you're profitable at some point. So unfortunately, you can't write off the whole amount, but you can continue to invest. And as you write off $3,000 a year, if you have 1 year where you make it all back or you have some good profit, you can write off that profit against that loss that you've been carrying forward over the years. So I hope that makes sense. So all is not lost if you've ever lost some money. If you get back in the game and you make a boatload of money, you'll get to write off that loss against that profit and only pay taxes on the difference. So let's talk about number two, the qualified retirement account. And then we'll transition and talk about the traditional IRA. These should be pretty straightforward, pretty simple. So a qualified retirement account, again, is a 401k if you work for a company or a corporate job, a 403b if you work in the public sector. The difference here is that money that you put into these qualified retirement plans, they go in tax deferred. So if you're not familiar with tax deferred or pre-tax or post-tax, money that you're trading with in the first example, in just your brokerage account, that is money you trade or invest with post-tax dollars, meaning you already paid your income tax on that, and now you put it in the stock market. And if you make money, you're taxed again. Well, qualified retirement accounts, they take the money out of your check, out of your payroll before it's taxed. So if you make $50,000 a year and you put $20,000 into a 401k or 403b, that $20,000 doesn't get taxed as ordinary income from working your job. The Social Security, the FICA, Medicare, none of that touches that $20,000 because it goes into your qualified retirement account, right? You're probably putting $1,500 a month or whatever that equates to equal $20,000 a year. And so that goes in pre-tax. Now, as you invest in that account, if that account grows, that money is what's called tax deferred. You're not taxed until you pull the money out at a qualified retirement age, which is usually 59 and a half. So at 59 and a half, you can start pulling out your money tax without penalty. So it's penalty free. But then at that age, when you pull money out, it's still taxed. It's taxed as ordinary income. Now, the thought process from the government is that at that point in your life, their thought process is that you're not making as much money as you were in your youth. So in your youth, if you're making $100,000, that ordinary income, if you're making $100,000 and then you pull $20,000 out from the stock market, you're at $120,000 of ordinary income. That puts you in a higher tax bracket from the stock chart or from the tax chart from long-term or short-term capital gains. However, they expect as you get older in life at 59 and a half, they just assume you won't be making $100,000 a year. And so when you pull out $20,000 to live off of, if that's a long-term capital gain and you don't make any other money, that could fall under the 0% tax filing status. Because remember, if you're single and it's a long-term capital gain, $0 to $40,000 is tax-free. So you could technically pull up to about $40,000 out tax-free if you're single, age 59 and a half, and it's a long-term capital gain out of your qualified retirement account. And so that's the thought process, is that your ordinary income that you were earning from a job will basically decrease to zero because you don't have a job anymore. You only have maybe your pension that you're getting or your withdrawals from your 401k, which again, you could potentially pay 0% on that, depending on how much ordinary income that you make combined with how much money you pull out and then seeing where that falls in the chart. So that's one way that you can invest in a tax advantage type of way. Now, one of the disadvantages of investing in the 401k or 403b is that you don't necessarily have control over the stocks that you pick in that portfolio. You don't necessarily have the ability to trade options. You only have whatever the employer allows from Fidelity. You might have 2 or 3, 4 plans you can pick from, and then that's it. And you got nothing else. So that is one of the downsides. But from a tax advantage side, when you're 59 and a half, hey, it's possible you can pull some money out tax free, depending on where you fall at in the tax bracket. The third way that you can invest in a tax advantage type of way is through a traditional IRA or a Roth IRA or a rollover IRA, which means you already had an IRA and you rolled it over into a Roth or a traditional IRA. And a traditional IRA stands for individual retirement account. It means someone like me as a business owner or just someone who doesn't have some type of defined benefit plan or qualified retirement account plan can put money away and still create our own retirement account. And most people are familiar with a Roth, but if you're not familiar with the Roth, for example, a Roth will allow you to put money in that is tax. I believe you can put the money in tax pre-tax. I'm not sure. Don't quote me on that, but I believe you can put the money in pre-tax. But what's most important about it is that the money technically grows tax free. And so, but they cap you. I think the current contributions are $6,000 or $7,000, depending on your age. It's $6,000 if you're under, I believe, 75. And then I think it's $7,000 if you're over. Again, just big picture. The point is, these are qualified retirement plans similar to your 401k or 403b that you can still put money in. Let's say you work in construction. Let's just say you are self-employed, something where you don't have a 401k, a 403b. You can create a traditional IRA, or If you don't make too much money, you can put money into a Roth IRA, or if you're already in an IRA and want to roll it over to one of these, you can do a rollover IRA. The bottom line is it works the same way that the 401k and the 403b works from a tax advantage standpoint. It's like you have to wait till you're age 59 and a half to pull money out, and you fall within a certain tax bracket depending on your ordinary income. But again, the government is hoping that at age 59 and a half, I shouldn't say they're hoping, but they're trying to give you the benefit of the doubt that you most likely won't be working or making a high amount of earned income at 59 and a half. And so when you start to pull that money out from the stock market from your investment, it technically should be taxed at a lower rate because your earned income will be down to almost zero with the exception of the money you make from your pension. So you can pull out, depending on how much if you're single, up to 40,000, if you're married, up to 80,000, you have to look at the grid, but you can start to pull out money and maybe live off of it tax free because you invested in one of these qualified retirement accounts or traditional IRAs. So just to recap, if you're trading inside a regular brokerage account, WEBULL, Robinhood, Charles Schwab, anything like that, they're going to ask you two questions. Number one, is it short term or long term? And then they're going to add it to your ordinary income, and you're going to fall within the bracket, and you're going to pay taxes. There's no real tax savings. There's no real way to avoid the taxes. It's just a matter of, is it short term or long term? So if you got a trade or an investment that is at the 11th month mark and you're ready to close it out, sometimes people wait that one extra month so that it can now become a long term capital gains, and it can fall under a little bit lower tax rate or tax bracket. And then the other two accounts, qualified retirement account, 401k, 403b, it's taxed as ordinary income, but only after you start to withdraw to age 59 and a half, with the expectation that you won't have that much ordinary income anyway. So it's possible to pull that money out, or at least a portion of it, tax free. It goes in tax free, and it could possibly come out tax free. It's possible. Same thing with the traditional IRA, Roth IRA, rollover IRA. The money goes in, and as long as you don't pull it out before age 59 and a half, it's quite possible, depending on how much ordinary income you make, it's quite possible that you can pull that money out, or at least a portion of it, tax free as well. So that's taxes, ladies and gentlemen. Big picture, know how taxes work. Don't go out splurging and spending all your money, especially if you're one of these people who are just getting into trading, or you just got into the investing trading over the pandemic and everything was up and you made a boatload of money and you never thought once about how taxes work. Well, now you know. Take your ordinary income, take how much money you made, put those two together, ask yourself two questions. Is it long term or short term? And then look at the grid and drop yourself right in one of those spaces, and it'll tell you what percentage you owe in taxes. So if this has been helpful and you're watching this live, be sure to give this video a thumbs up. And while you're at it, hit the subscribe button for more videos. If you're listening to this on the podcast, on Spotify, iTunes, all the platforms, leave us a comment or a review. Let us know, what was your biggest takeaway from learning and understanding how taxes work for trading? And I'll see you guys on the next episode. I'm signing off saying, remember, you never go broke taking a profit.